Welcome to Season 8 of the FarrCast, bringing you insights into Wall Street, Washington, and the world. Now here's your host, Michael Farr.
Welcome to the FarrCast. I am Michael Farr. Thanks so much for joining us again this week. It is January the 16th, 2025, January, couple of weeks into the year. Doesn't it feel longer than that, huh? With all that's going on in the world, don't you think it's been longer than 2 weeks? I feel like it's been at least a month. The news with the wildfires and what's going on in the transition and the inauguration on Monday and everything else, and President Carter's passing. Geez, this has been a full chocolate blocket of time. And yet, we're looking for positive economic growth still, 2.7% or so for 2025. 10-year Treasury got up above 4.8%, and now it's rallied back to 4.64%. That rate came back down. It's bounced. I don't think it's the last of those high testing anyway. Expect that 480 and maybe even a push to 5 before this is over. Oil bumped up over 80, now back in the 79 range, and I've heard a lot of explanations. Analysts from Goldman Sachs this morning on CNBC said, well, it's a much colder winter and we're using a lot of oil. Soon as I heard that, I thought they have no idea why oil prices are higher. I'm telling you, that's the go-to argument that you've heard your entire life if you've listened to any economic news. And whenever oil prices go up, that's the first thing. If they don't know what the hell to say, they say, well, it's a colder winter. Okay, great. Anyway, oil prices are going up. I might have something to do with that Russia thing, too, that we're putting on more restrictions on trade with Russian oil. Gold above 2,700. The dollar is stronger. $1.02 versus the euro. We're about parity. You want to go to Europe, folks, go to Europe. You can get a great bottle of wine for a lot cheaper than you could even a year ago. Futures are slightly up. We've had a bit of a bounce this week, but the first couple of weeks of the year haven't been all that good. So we'll see and talk to Kenny Polcari about the January effect this morning, what's happening with 2.7% economic growth and what it all means. In our third segment today, Dr. Jay Bryson. Dr. Jay Bryson, our chief economist from Wells Fargo, they're looking for that 2.7%, and he says only 2 rate cuts from the Fed in the second half of the year. I bet you'll hear that Polcari and Farr agree that we might not get any rate cuts at all in 2025. If the economy continues to do okay, there's no reason for the Fed to add fuel. Just think about it that way. If everything's buzzing along, there's no reason to add gasoline to this if you're a responsible Fed. Kenny Polcari is CEO of Case Capital Advisors, and he is the chief market strategist for Slatestone Wealth. Welcome back, Kenny Polcari.
Oh, Happy New Year to you. Thank you for having me back. And as always, that's a great introduction. Your whole monologue, I think, hit every nail on the head about where investors are and kind of what's been driving the markets and what's going to drive the markets. So I think we're going to have a great conversation this morning.
Well, and one of the things I'm looking at, Kenny, is if we have this 2.7% GDP growth, okay, the economy is expanding at 2.7%. If stocks are already trading at 21 or 22 times earnings, where do stocks get an upside? They either get an upside because the price to earnings multiple goes higher, or earnings go higher to drive stock prices. How high can earnings go on a 2.7% GDP number? I'm thinking 8 to 10%, maybe. What do you think?
Well, so I do agree with you, although I think the street is a little bit more optimistic.
The street's always more optimistic.
Yeah, but not as optimistic as they have been, right? No one thinks that we're going to get 20% plus returns in stocks this year like we have for the last 2 years. So I think that's off the table. But the optimism is still high, right? There are some on the street looking for 10 to 12% earnings increases. The start of this earnings season shows the banks performing very, very strong with great forward guidance coming out of the C-suite that we've heard so far, right? So there is a sense that there could be some opportunity. And now, to your point, Do I think stocks, go back to a normal return, 8 to 10%, add in divvies, maybe it's 10 to 12%? I think absolutely that's kind of where we're going to be this year, which is certainly not bad, but it'll look kind of negative based on where we were the last 2 years at 20+%, right? But one way or the other, it is a return to normalcy. And so if GDP stays at 2.7%, which is okay.
Yeah, it's good. I mean, it's fine. It's not fabulous, right?
It's not
fine.
fabulous. It's okay. But look, if we get this new administration, if we get oil down 50% the way Trump says he thinks he can do, if we get tax cuts, which returns money to consumers and to Americans, and they feel more opportunistic, they feel better about themselves, they feel better about the economy, could we see the economy continue to push along? I think we absolutely could. The issue is going to be is if we see the economy start to fail, right? That's going to be where maybe we run into a little bit of trouble. But at the moment, it doesn't feel like that, right?
Did Trump really say he can get oil down 50%?
He said that he was going to get oil prices down 50%. Now, what's interesting is...
So wait a minute. That means we're going to see oil, even with the new high, we're going to get oil back to $40 a barrel? $40 a barrel?
$40 to $50 a barrel.
In what world does oil hit $40 a barrel?
Well, agreed. I think all I said is he said. I didn't say necessarily that I agree, but it is an aggressive move, right? But if he opens up the spigots the way that he wants to, the way that he tells everyone he's going to, then, we should see supply increase and price of oil retreat a little bit. And look, oil prices have rallied in the last week and a half because Joe Biden, at the last minute, introduced these new sanctions on Russia, takes 700,000 or 800,000 barrels of oil off the market, and we saw oil prices rise, right? Now, Joe Biden does that on his way out the door to leave Trump with an extra problem of higher oil. Right before he did that, don't forget, oil was trading at $70 a barrel.
He's going to lose. Right? He's going to lose every dollar of support, of campaign support and donations from the American energy industry in this country. It will collapse at $40 a barrel in oil.
Right. So I don't think it's going to 40. I don't think it's going to 40. Look, he says 50, but sometimes he can be dramatic about it, right? But would I like to see oil back?
Wait. Sometimes Trump can be dramatic. Is that what you? Sometimes.
Yeah.
Wait, tell me the time. Give me 3 examples of when Trump's not dramatic.
Let me restate that. All the time.
Hey, okay, good. This is good. All right. Okay. Wait. Hang on. I got real questions here. So look, we've got now the Elon Musk sort of push to cut spending.
Yeah.
So you and I have already agreed, because you and I talk all the time. We already agree you can't cut $2 trillion in U.S. spending. It's not there. But let's just say they could cut $750 billion in excess wasteful spending if Trump can find it, if Musk can find it. So you start taking money out of the system. That's just money out of the system. If you take money out of the system, that's the same as the Fed raising rates. It's a fiscal tightening as opposed to a tightening of monetary policy. So meaning the government's not spending as much, and it'll be $750 billion, $750 billion. They're not spending. So all of a sudden, that's tightening the economy, even though he doesn't want Jay Powell to do it. That reduces growth. And now let me be really clear about something. We should reduce that spending. We need to cut wasteful spending, but there is pain involved when you cut spending. You're not putting money in, you're taking money out.
Okay, but listen, I think I'm going to take the opposite side of this argument, because I think
I'm not arguing.
I think we're talking about a different narrative. If he cuts spending in Medicare and Social Security and defense, that's one view. If he's cutting spending because they're cutting wasteful spending, I actually think that Americans in the economy would appreciate the fact that he can say, look, I haven't cut Social Security, I haven't cut Medicare, I haven't cut defense spending, but guess what? We're not wasting money anymore over here, 1, 2, 3. And he identifies where they're not wasting. I actually think that's a positive, and I think Americans will embrace that. And I think the market will embrace that.
You think they'll embrace it even though it's going to be painful? You think they'll say, okay, we'll suffer through this in order to get to a better place fiscally? They've never said that before.
Okay, but because I think, again, we're talking about where are we cutting? Are we cutting where people think it's necessary or where they think it's unnecessary. So when you tell me that, we're spending $100 on a screw that the Pentagon needs because that's what the Pentagon is paying when the screw costs $5, I think they say, yeah, that's a positive. I think that's a positive.
I know plenty of guys happily spend $100 for a screw. Okay, I shouldn't have said that. Harry, you may need to cut it. I'm sorry. It was just,
You're killing me. You're killing me.
Big fat pitch down the middle. I couldn't.
No, actually,
I'm sorry. I couldn't. Okay. I'm sorry. I couldn't. I'll move on. All right. Now I've distracted myself and I don't know where to move on. Okay. Okay. So, Kenny, there is what we're talking about when we talk about this push-pull between we're going to have a tax cut maybe, and then we're going to have this, and maybe oil's going to go to $40 a barrel, which isn't going to happen. All of these headlines can be disruptive to markets. And when we come back and say, let's see if we can really get to this 2.7% growth number, maybe we get an 8 to 10% year on stock. And ladies and gentlemen, the best thing we can tell you as investors, Kenny, you argue with me, but the best thing I can tell you is to go get the cotton balls and shove them in your ears, mute the television sets, and leave your stock portfolio alone, because you're going to hear a lot more upsetting stuff that could be confusing. And if you listen to one of these, what did you say? Dramatic. What was the word?
Headlines. Dramatic headlines.
Dramatic headlines from President Trump. You really can't listen to so much the first proposal. You have to pay attention to the policy, and very few of these proposals actually get word for word to policy. In fact, none. So this is posturing, and it's effective. Don't think I'm taking shots at President Trump. It's a different way of governing. It's certainly not my style or personality, but he has been effective with a good deal of it. And when you look at what comes out in the wash, there have been some very positive things in his first term that came out well in the wash. There were a bunch of things in his first term I didn't like at all. So right. I'm very concerned about our international relations. I'm very concerned about what we do with NATO. All of these things I think are hugely important. And so I don't go, I was never 100% for or against any president, for or against any president. So you pick the one, and I'll tell you there was something wrong with them, and I'll tell you something that I liked about them. So that's just me and presidents. I tend to watch all of them very closely, and I watch what they do, and I listen to what they say, but I more watch what they do. All right. So Kenny, give us your word for Fred and Ethel as we look to invest through this time where stocks are fully valued. I think you and I agree. We're still due for a pullback that we haven't seen. What do they do for 2025 after they put the cotton balls in their ears?
Well, I think that's exactly right. They listen, they put them in their ears, right? So they're not paying attention to every headline, and they're talking to guys like you and me. They're advisors that are watching it, that are managing it, that are creating well-diversified portfolios to manage through a volatile market. So I think Fred and Ethel need to just sit back and trust and know that guys like you and I are taking care of it. And we're watching and we are paying attention to what's happening and we're making the appropriate moves. But one way or the other, you got to be in it for the long term, and investing in stocks has always been the answer for long-term wealth generation.
And the best thing you can do is hire Farr and Polcari. I like any sort of argument that ends with that in conclusion. I thought that was artfully done. Not that we're just shilling for business, but trust me, if our lips are moving, we're shilling for business. We're always shilling.
Farr and Polcari, are you and I in business? How I love that idea. Farr and Polcari.
Let me tell you, our clients, there'd be a line out the door, Kenny, for Farr and Polcari.
What the heck are we waiting for? Let's go. I'm happy to come over there to Naples and sign the paperwork.
Good. Let's do it. All right. If any of the legal department's listening, we're joking. Kenny Polcari is CEO at Case Capital Advisors, Chief Market Strategist for Slate Stone. And your podcast, Kenny, is what? And where can we find it? Fast. I got to go to
the podcast is on Yahoo Finance. It's called Trader Talks. I do it right from the floor of the New York Stock Exchange. It's actually going to launch in a couple of weeks. So it hasn't launched yet, but I will keep you abreast.
Trader Talks from the floor of the stock exchange with Polcari. We want to follow that, Harry. You make sure we have a link for it, will you? Thanks, Kenny. Coming up, Mahaffee and an inauguration and a deal with Israel and higher oil prices for Russia when we come back on the FarrCast.
And starting off this morning with the most marvelous looking Kenny Polcari.
What about me?
You're nuts.
Yeah, you look okay.
Yeah.
You're not Kenny, man. You're not Kenny.
No, not Kenny.
All right.
No respect. The Rodney Dangerfield of financial media. That's me.
All right. 3, 2, 1.
Thanks for being with us this week. Now it's time to go to our political analyst, Dan Mahaffee, and your host, Michael Farr.
Welcome back to the FarrCast. Joining me now, as he does every week, Dan Mahaffee, Vice Chairman of the Dr. Scholl Foundation, scholar at the Center for the Study of the Presidency and Congress, a Washington, D.C. think tank, and senior political analyst, now in Season 8 on the FarrCast. Welcome back, Dan. How are you today?
Doing well. Good morning, Michael. Great to be talking with you.
Chilly in Chicago, is it?
It is. Although we're having a brief warm up to 40, so get the shorts out, get the barbecue, and then it'll be back down to the single digits over the weekend.
It's one of the things that I miss about being in Washington in the springtime, and I don't miss many things, but Washington in the springtime is actually very beautiful. But when it would hit about 55 degrees and I live up near American University, the kids would be out in shorts with their shirts off throwing frisbees at 55 degrees, celebrating springtime. And I'd think, no, it's just too damn cold. No. All right, Dan. Inauguration on Monday looks like a peaceful transition of power. Washington is getting bolted down and fenced up to get ready for any possible trouble, but shouldn't be any. Should there really? I mean, they're going to take the flags on the Capitol building back to full staff for the inauguration. And it looks like President Trump does want a complete motorcade. What are you hearing about the inauguration coming up?
I think other than that, it's now more of a armed camp than the festive parade that we know that it'll largely go off without a hitch. It's going to be, if the forecast is correct, probably the chilliest since Reagan's first inauguration, which, as we recall from history, they ended up having to move indoors because it was so cold. I don't know if that will be the case. It's one thing to keep an eye on. I doubt, though, that the president-elect would like the imagery of having to change it, so I expect it to go ahead outdoors. That said, it's a question we see, and I think we touched on it last week, but it weighs in now too that the Senate confirmation hearings have begun for Hegseth and Rubio. You have these debates ongoing still about just how the reconciliation package is going to come together. If there are spending cuts, how big do they need to be? All the details of a tax bill, back and forth among those who are worried about the SALT. There's a lot of details that are being hashed out, and a lot of things that, as we talked about with any honeymoon, are looming on the agenda, be it the question of how you get things done, or we don't have a date yet, but when will we hit that debt ceiling, and when does that need to be resolved by? And will they be able to do that with Republican votes alone, or are they going to have to get Democrats on board, and how?
Well, so the debt ceiling is a big deal, and the Republican side of the aisle is very divided about this. And it looks fairly likely then that we will hit that debt ceiling and could go through a government shutdown very early in President Trump's term.
You do have that. I think you've seen the back and forth, though, because again, with the debt ceiling, that is the question of, the full faith and credit of the United States, and no party really wants to push through that, much like they would a more traditional government shutdown or budgeting. So it's a more severe bump in the road, as it were, for them to be looking out for. If not a bump, a wall in the middle of the road they have to be aware of. So that's why you hear things notionally, and the trial balloon was shot down about tying the debt ceiling to disaster aid, but they're going to have to do something about it.
I have a feeling, Dan, that President-elect Trump right now is a good deal more powerful in Washington, and this is a feeling as a Washingtonian, lifelong Washingtonian. Uh, I have a feeling that he's much more powerful, that people on Capitol Hill feel more threatened, and that his ability to call people and say, cut it out and vote, basically, or else, which is something that every president has done, or else, there's an or else you'll be primaried, or else we have a file on you, or else, there's an or else we're not going to support whatever it is you want to support. That's child's play, that tit for tat on support.
Mhm.
He seems to have pretty much most of his people in line. How long does that last? Because it wavered and flipped in his first administration to where there were Republicans distancing themselves from
Mhm.
him. Does that happen again? How long can he hold on to this kind of power? If you agree with me that
Yeah.
indeed he does have this kind of influence.
Look, he has that influence among certain elements. If you've come to Washington because you're part of the MAGA wave, or that's the block of support you've ridden to office, you're very reliant on him. But there's also, quite a few senators or others. I would actually lean more to senators than members of the House, but senators who would get a call from like that from the president and say, so what? You know, motivate these voters in 6 years on this issue. See if they're as fired up. Those are the kinds of things that still matter, particularly when it comes to these nominations, or, some of them who are approaching the end of their careers. Mitch McConnell's a good example. Primary me, fine, I'm retiring.
Right.
Those are the kind of logics that, look, Trump is certainly powerful, and I think you see it. And here's the example: the Mike Johnson is saying it was his choice to remove Mike Turner as chair of the Intelligence Committee. But look, Mike Turner from Ohio, Republican, good guy, consistent critic though of Putin and Russia. And it's again, why is he being pulled from the Intelligence Committee at this point? It's an example though of that power applies to a body like the House, where you have that narrower majority, you have the elections every 2 years. I don't think you feel that way with the senators, though.
Okay. So this will be very interesting if President Trump doesn't want a government shutdown in his early days, or maybe if it does happen, he will have a way to spin it to the public and say, see, we mean business and we're going to get this out of the way early and we're going to fight on this, and then it'll go the way it always goes.
Yeah, but the big question is how long. He had the luxury for the past 4 years of being able to run on nostalgia as well as someone else being in charge. Now the
And
buck will stop with him. If the oil isn't getting down 50%, if the eggs aren't going down in price, if all these other things that are promised aren't happening, who does he blame it on once he's president? That becomes the problem when it comes to the spin that he's done so well out of office. How will that apply once in office? He can, maybe he'll blame Elon, maybe he'll blame Vivek, maybe he'll blame JD at some point, but ultimately he won't be able to blame things on Biden.
um, Harken back with me now, Dan, just because I am actually remembering this, and you will not be because of your tender age. Sorry, ladies and gentlemen, if you actually remember this, it means you've got a few gray hairs. But 40 years ago, 40 years ago in 1985, on January 21st, President Ronald Reagan was inaugurated for his second term, inauguration. It was the Reagan inauguration, and it was 7 degrees in Washington. 7 degrees. It was cold as hell in Washington, and they had really a private swearing in ceremony because they thought it was too cold for the elderly president to be outside. They were worried about his age. They were worried about his health. They were worried about just that he was so old. At that time, ladies and gentlemen, Ronald Reagan was 73. He was 73, and he was the oldest person to have ever been inaugurated president at the time. Just think about that for a little while. Warren Burger was the Chief Justice who swore him in as Nancy Reagan held the Bible. George H.W. Bush had been sworn in by Potter Stewart. Who was one of the nicest justices in Washington, by the way. Okay, Dan, as we look around at the end of President Biden's term, and I've only got 3 minutes left. Gosh, I've got to get through a lot of stuff. President Biden has pushed this deal with Israel. It's happened at the end of President Biden's term. He's imposed sanctions and extra tariffs and trade restrictions on Russian oil, and we've got the price per barrel a good deal higher. Will these deals hold? Are they particularly meaningful? There's supposed to be a ceasefire in Israel starting this Sunday. I always see that and go, if you've got a ceasefire negotiated, why are you going to keep shooting at each other for the next 4 days? Why? You came to a deal. Quit shooting each other. I've never understood war, but you actually have a background in security studies, so give me some of this and fast, please.
Well, I think to answer your question, because there's still targets you want to hit and time to hit them before the ceasefire takes effect. And I think that's actually what we see happening this morning with airstrikes in Gaza by the Israelis, and rumors, too, that some in Netanyahu's cabinet are getting cold feet. And I think ultimately at the end of this, it just shows you that Benjamin Netanyahu is able to run circles around a U.S. president. And that'll be, I think, one of the ultimate things that goes into the post-mortem of the Biden legacy, both on foreign policy and, frankly, his election loss. Harris's election loss. But what the collapse in support among young people, Arabs in Michigan and others meant because of these policies. But you hope, at least for these families of these hostages, that this deal does come in place and that there is some happiness for those who return and closure for those, sadly, who will not.
I love one of your comments from a few weeks ago, which was that Benjamin Netanyahu has been perhaps one of the most successful politicians in U.S. history.
Yes.
I mean, he has done better as a politician in the U.S. as a whole hell of a lot of U.S. politicians. This guy's brilliant, and he knows how to work the U.S. He really knows how. So we'll continue to watch that.
We'll continue to see with that. But look, this deal, while the contours of the deal were what Biden suggested, it was Trump's envoy who did come and push it through at this final hour. So it is a reflection of the, a changing tune, perhaps on this. But look, on the other side with Russian oil, look, these sanctions come into place. There's also restrictions on AI and chips to China. But look into the details of what's happened when the Finns actually took this tanker that had been operating in the Baltic Sea, cutting underwater cables. Not only are these oil tankers moving Russian crude, they have intelligence equipment on them. They have tools for cutting cables and infrastructure on the seabed. The Russian oil industry is not just shipping crude. This is part of their broader intelligence and ne'er-do-well network.
Okay, so everything that you're seeing makes sense, and it looks like the Trump administration will uphold it. When I was starting out as a camp counselor, there were 2 camp counselors in the cabins of, 15 boys in a cabin, campers, and then there would be 2. And they were teaching us about discipline, and they taught us a bunch of things about discipline before we started to be junior counselors and counselors. And one thing they taught us was about discipline. And then the other thing they taught us was about unity. Okay, those were the 2 lessons. And discipline comes from the word disciple, and you start with discipline by leading by example. And they also said, and look, if you threaten a punishment, you have to be prepared to carry it out. So don't threaten to kill the boy if he doesn't make his bed, unless you plan on killing him. That's fine. If you plan on killing him, you can threaten to kill him. Otherwise, threaten to give him a timeout or go make him sit on the steps or something like that if he doesn't make his bed, and then carry it out, and then you will have real authority. Second, there has to be consistency and unity so that you and the other co-counselor agree on the right level of discipline and carry it through and avoid what they called the mommy-daddy approach to circumvention. You get one guy, one end of the cabin counselor says, yeah, it's okay. It's no, you can't go swimming now. So they go ask the other guy and say, can I go swimming now? He says, yes. You always have to say, what did the other guy say? Make sure you're together on those things. I think really basic lessons for governing, right? And in this transition, will we do what we said we were going to do, number one, and will the other guy at the other end of the cabin, this time being President-elect Trump, actually be consistent with what President Biden said? So this is very important, and I think it's very hopeful, and I certainly hope that it ends the violence there. Do you think it will end the violence? Will this actually lead to a real ceasefire that holds stand? None of the others have.
Yeah, I don't know. I have my doubts that this is, in a way, a temporary ceasefire that will hold as a gesture to the new administration before we see an escalation either in Gaza again, towards the West Bank, or even Iran. I see this as something to buy time for Israel to prepare for something larger rather than a resolution of this conflict.
So there's a no. We're going to watch what happens in Russia. I keep wanting to say the Soviet Union because that's what it feels like, and I was in the Soviet Union, so this is still what it feels like. Okay, and we'll get to China, and we'll do it all next week. Dan, thank you so much for being with us. Ladies and gentlemen, we're going to come back with Dr. Jay Bryson, chief economist at Wells Fargo, and we're going to ask him some of these Polcari questions. If we get 2.7% growth, what does it mean for these other policies? And when he comes up with 2.7%, is he calculating tariffs? Is he calculating a debt ceiling, firm hold, or a government shutdown, or any of those things? When we come back on the FarrCast, please stay with us.
Michael Farr and the FarrCast are proud to support Heroes, Inc. Heroes supports the spouses and children of law enforcement officers and firefighters who gave their lives in the line of duty to the greater Washington, D.C. community. Their singular goal is to honor the supreme sacrifice made by these individuals by caring for their families. Heroes' work begins within 24 hours of the tragic loss and continues indefinitely. We invite you to learn more about Heroes' mission at heroes.org. We hope that you will consider supporting Heroes as they endeavor to honor those who protect us. That's heroes.org. Heroes, here for you, here for good. And now, back to the FarrCast and your host, Michael Farr. Thank you for joining us on the FarrCast. And now, back to your host, Michael Farr.
Welcome back to the FarrCast. I'm Michael Farr. Joining me now, a FarrCast fan favorite, one of the most prestigious guests we are honored to have on the FarrCast. Dr. Jay Bryson is the chief economist at Wells Fargo Advisors, and he was at the Federal Reserve. He's a PhD economist. You see him on CNBC and all over the financial media. One of the smartest, most level-headed guys I get to talk to. I mean, when we get between Jeff Lacker and Jay Bryson, I'm telling you, you learn a whole lot listening to these guys. It's a privilege to have you back, Jay, and Happy New Year.
Well, Michael, it's always a privilege to be with you, and Happy New Year to you as well.
Thank you very, very much. We've been talking about Wells Fargo's report, your report on GDP growth for this year. We were talking with Kenny Polcari about some of the cost-cutting measures here in Washington, and whether some of the Republicans and how hard some of the Republicans would fight sailing through a continuing resolution or an increase in the debt ceiling or any of those things. We think they look pretty dicey. Dan Mahaffee agrees that they look pretty dicey. And as you look at your forecasts, you've still got a positive number for 2025. looks like we're north of 2%, but not the 2.7% we saw in the fourth quarter. Probably something closer to 2.1% for the year. Is that it's a positive year? Is that an average sort of a GDP year?
Well, so Michael, I guess to put it in perspective, to kind of level set here, if you go back and you look at the 2010 to 2019 expansion, 10 years, right? And this is kind of, recent memory. Most folks would, kind of remember what that kind of felt like. So over that 10 years, on average, the U.S. economy grew 2.4% per annum. So if we're looking at something closer to 2%, it's called a little bit below average. It's not a disaster, but it's a little bit below. And, we estimate that, again, to put that in perspective, in 2024, the economy grew, somewhere around, 2.8% or so. So it's a downshift in terms of economic growth in our forecast for 2025.
Jay, I'm gonna mess up the exact year. I'm just because I can't quite remember, and as everybody knows, I'm old. So if we go back, let me see if it was 2021. Might have been 2021 or 2020. 2021, I think, when we had the highest rate of inflation, perhaps for the year, was around 9%, and GDP growth was still awfully high. I mean, it was what, 11%? Is that what it was? So it gave us about a net 2% real year, something like that. I'm messing up those numbers.
Yeah, so in nominal terms, I don't have it here at the top of my head. It may have been, 10%, 11%. So that would be in dollar terms. And as you point out, it was because of high inflation. When I go back and I look at those years, I say, that's distorted, right, by the pandemic.
Yes.
Pandemic shut down the economy in 2020, and then as it comes roaring back because of fiscal stimulus and monetary stimulus, et cetera, you get this huge bounce. And so, I would say kind of ignore that sort of year. But again, just to put things in perspective, I think most of us agree 2024 was a pretty decent year, and that was roughly 2.7, 2.8%.
And so the point I'm trying to get to, ladies and gentlemen, is that when you look at economic data, you look at nominal rates, as Dr. Bryson just said, and real rates, which are adjusted for inflation. So one of those years you might have seen this huge growth number. Let's just for the sake of argument say it was 10%. But if you look and see that inflation was 8%, so that the price of everything went up 8% and 10% growth, no. In real terms, then you only really had 2% growth. See, because a lot of it came from inflation and just higher prices across the board. My point here, Jay, is when we look at this 2.8% in 2024, inflation was what in 2024, and was that a real number or a nominal number? How do we feel about? How do you look about that? Look at that.
So, if you look at the real number, the inflation adjusted number for 2024 is going to be 2.8%.
Yep.
The inflation rate last year, the CPI inflation rate, is going to average somewhere around 3%.
Right.
It's certainly not the double digits that we saw back in 2022, but it still is higher than what the Fed would like. In general, Michael, when I look at the economy today, okay, so maybe inflation, it's running around 3% right now. It's a little bit high, but it's certainly not double digits. You look at a really strong real GDP growth rate. You look at the unemployment rate, it's about 4%. I don't want to say this is as good as it gets, but this is pretty darn good, right? I mean, maybe it's not the late 1990s, but it's pretty close to that. The U.S. economy is doing very well right now, particularly when you compare it to the rest of our trading partners, like Western Europe and Canada and places like that. Some of those economies are not performing as well as what the U.S. economy is right now.
FarrCast listeners, I can hear you all thinking, hey, Farr, why don't you ask Bryson about Jack Barugian? Because Jack Barugian thinks that 2025 could be one of our greatest years in the market ever, a strong beginning for the economy that's going to go on, all because of productivity added from AI. How transformative can AI be when you consider GDP growth as that combination of increase in workers' hours or increase in the labor force plus productivity? Can productivity with AI really rocket in such a way that we continue to have outsized growth?
So, Michael, I think AI is a productivity game changer, but I don't think it's going to move the needle much here in 2025. I think it's more of a, let's call it, it'll really start to take effect in the late 20s, maybe early 30s. And compare it to the internet and the networking of computers, right? So the internet was invented in the early 70s. It didn't really become part of our lexicon until let's call it the late 80s, early 90s. And it didn't really start to show up in terms of the productivity figures until the late 90s. Now, artificial intelligence, has been around
That's really cool, by the way. That's really cool. That's really cool data that when the internet was founded, but then it really started so in the mid 90s, of course, you and I were getting floppy disks in the mail that we could plug in to our desktop computers and run them and hook them up to the modems. And young people don't know this. They used to go, and you'd dial in on your phone line and you'd run the AOL software and you could get on this magical thing on the internet. That was in the mid 90s. That was 1995, 1996. And that actually showed up in productivity numbers by the end of the 90s. Fascinating. And so when we look at these trends, and we were following Moore's law in terms of speed and transmission speed and fiber optic cables, very interesting to try and draw parallels to what we're seeing now, though the expansion and I guess the application of Moore's law almost with AI feels like it could be slow. What do you think?
Yeah, it's going to take hundreds of billions of dollars to completely build out AI. Not only when you think about AI, you think about software, but it takes a tremendous amount of hardware as well to do that. And again, this is nothing. You're not going to take hundreds of billions of dollars of expenditures this year. It's more of a slower sort of process. Yes, cutting edge tech companies are using AI. They're starting to experiment with it, but it really has not become business as usual for medium and small companies yet. That will happen, but I think that's going to happen in a slower sort of pace. And again, when I think of AI, I think of it as being kind of the late 20s, early 30s, where it really starts to show up, in terms of the productivity numbers.
Okay. All right. So you take all of this, in, and we look at your 2.1% perhaps for 2025, which isn't bad. Jay, when I was looking through your report, your end of the year numbers really start to kind of crater. The weaker part of your forecast is in the second half of 2025. What's going to happen in the second half of the year that has you guys so worried at Wells Fargo?
Yeah. So, Michael, what it is we're assuming that you're going to get some sort of tariff increases this year.
Okay.
And when you get a tariff increase, so first of all, we don't know the exact timing yet. We don't know the exact magnitude, but we take President Trump pretty seriously on his threat to impose some sorts of tariffs this year. And so what tariffs do is it raises prices. And as prices go up, people don't have as much real income, or to say that in English, purchasing power, as they did before, if they have to pay more for tariffed goods. And right. So, the shirts that you're buying from Vietnam, right, and they're costing you $50, now they go to $60. So now you have $10 less to spend somewhere else in the economy. And so that is a modest stagflationary effect on the economy. And what we're assuming is we're not assuming, at this point that you get, as President Trump, when he was a candidate, talked about 10% across the board, 60% on China from day one. We'll see what happens there, right? But we're assuming that you're going to get some sort of raise in tariffs this year, and it's going to, maybe it's more of a second half sort of phenomenon, and that's why we have the slower growth in the second half of the year. That's the placeholder assumption we're using. There's a lot of uncertainty about that right now. We'll see how things progress. But if we're right, and you do see some tariffs here, I think that's going to be a modest hit to economic growth this year relative to where we were last year.
I was asking Kenny Polcari in our first segment, Jay, how he squares the notion of proposed tax cuts along with spending cuts, along with fiscal restraint. Tax cuts are not fiscal restraint. That's easing. And I'd love to hear, as an economist, how you square that, or do you find it as contradictory as I do? And I want, the hard part when we talk about this, Jay, is avoiding the politics. I'm not being critical or supportive of President Trump's policies or what he's trying to do. I think we've got to have more fiscal restraint. I don't like the expansion and explosion in the U.S. debt at all. It's not sustainable. Do we need the spending cuts? Yes. Do we need the tax cuts? I don't think so. And I think those two policies are inconsistent. Am I missing something? Because Kenny thinks revenues go up if we have tax cuts.
Well, so I don't, not to inject politics here, but from a political standpoint, you think about what most Republicans believe, and they believe in a smaller government, so spending cuts, along with less onerous taxes. So from a political standpoint, all that makes economic sense to me. In some sense, from an economic standpoint, they would go in cross purposes. If you do have tax cuts, that's stimulative. On the other hand, if you have large spending reductions, that tends to slow the economy. So maybe those two things work at cross purposes. But in general, Michael, I really don't think you're going to be seeing a lot of deficit reduction this year. One thing that President Trump and most Republicans in Congress can agree on is to extend the 2017 tax cuts. So if you remember, but the way that legislation was written, those tax cuts go away for individuals at the end of 2025. And so if Congress does nothing, starting in January 1st, 2026, everyone's tax rates are going to go up. And so most Republicans agree to extend those tax cuts. Now, how much does that cost? That costs roughly $4 trillion over the next 10 years. And that's not stimulative. That's just ensuring people's taxes don't go up. And so to try to pay for some of that, that's where you have these proposals to try to cut government spending. And we'll see how much that actually happens. In theory, that's really interesting to talk about. But if you look at where do we spend our money on? It's on Medicare, Medicaid, Social Security, it's on defense, and it's on interest on the federal debt. Okay, so all those programs.
Those are the huge categories. And certainly they're all going up.
Yeah, and it's 80 to 85% of the federal budget. If you want to make a meaningful reduction in government spending in this economy, you've got to touch those programs. And for political reasons, at least at this point, that's all off the table. And so the point is, you're not going to get meaningful reductions in government spending, meaningful hundreds of billions of dollars. And so I think you're looking at a large deficit for a considerable period of time.
Large deficit for a considerable period of time. You said $4 trillion would be the effect of the tax cuts over the next 10 years. That's $400 billion a year, it just evenly spread out. Where do you think, therefore, the deficit, the national debt goes over the next 10 years? Something like that is going to compound a little bit higher just in the interest on the debt. Do you get to $50 trillion in the national debt over the next 10 years?
Yeah, probably. If you look at the Congressional Budget Office, the nonpartisan Congressional Budget Office, if you look at their projections over the next 10 years, and if you assume the tax cuts are extended, you're looking, and this is their baseline forecast, you're looking at deficit to GDP ratios on the order of 7 to 8%. And to put that in perspective, right now our deficit as a percent of GDP is about 6%. And if you look over the last 50 years, on average, we've averaged about 3.5% of GDP. And then again, as a percent of GDP right now, the debt of the United States, the entire debt, even the stuff that's held by the central bank and it's held in the Social Security Trust Fund, et cetera, you're about 120% or so of GDP. The CBO projects that goes up to about 150% or so over the next 10 years. And so can you get to $50 trillion in the next 10 years? Yeah, you very well can.
Okay. I've asked you before, at what point do you worry? Because I always worry, and you don't worry as much as I worry, which, probably is why you just have that Zen-like Buddha-esque demeanor all the time. Joe calm, easy going. I'm sitting here biting my fingernails, and I'll tell you, ladies, Bryson's just cool as a cucumber. But and part of your argument there is, hey, we are the world's reserve currency. There are not that many other places you can go. Don't panic here, too fast, too far. At what point, Jay, do you start to worry about 150% debt to GDP and $50 trillion in U.S. debt?
Well, Michael, the short answer is I don't know. I don't know when that point is. Nobody really knows. I mean, you kind of just mentioned it here. I mean, at the end of the day, there's really no alternative to U.S. Treasury securities as a financial instrument in the global financial system. And we remain the reserve currency of the world for a number of reasons. But it doesn't keep me up at night at this point. But there's an interesting line in Ernest Hemingway's "The Sun Also Rises." Two of the main characters talking to another character, and they said, "So how did you go bankrupt?" And the second character says, "Two ways: gradually and then abruptly." Yes. And that's how people kind of go bankrupt, right? They're living above their means for a period of time, and then all of a sudden the credit card companies start to bang on their door, and et cetera, et cetera. And you could potentially, and I'm not saying this is going to happen, in this year or next year or the next 5 years, but if you think what happened, some of the listeners may remember in the United Kingdom back 2 years ago when Liz Truss came into office, she proposed a bunch of tax cuts.
Who?
Prime Minister Liz Truss. She was around for 43 days. I think that's 43 days.
Well, hey, that's 4 times longer than Scaramucci lasted in the first term.
Good point. A good point.
It's relatively good. Go ahead. Sorry.
But anyway, she proposed a bunch of tax cuts without any spending sort of restraint, and the UK bond market threw up.
Yes.
Long yields there just skyrocketed. Now, the UK bond market is not the market for US Treasury securities, but the point is, again, to go back to Hemingway, how do people go bankrupt? Gradually and then abruptly. And at some point, who knows when or who knows why, investors could say, you know what? These yields on the 10-year Treasury security of 4 to 5% don't make any sense anymore, given the what's going on in Washington with the spending and the tax cuts there. And we demand a higher interest rate to hold that. And nobody knows when that time's going to come.
And what he just described, ladies and gentlemen, is the very thing that keeps me awake at night, Two things, Jay, and we've got to go, but two things, and I can't tell you how much I appreciate your time. we've kept you a little long today, but boy, we're learning a lot. So thank you. Two things, and I'm going to say them both at once because if I don't, at my age, I'll forget the second one. If I haven't already, we're going to find out in a second. I don't know until I start talking. First, Greenspan suggested in the early 90s that we would be on, that we could easily have the yuan, the Chinese yuan, as the reserve currency, as the reserve currency of the world. Does that make any sense to you?
That makes, as much as I respect, Alan Greenspan, and I worked for him for a few years. I don't share that opinion at all. Why is the U.S. the world's reserve currency? Well, there's a number of reasons. Largest economy in the world, biggest military, et cetera, et cetera. But the most important reason is we have the deepest, most liquid, most transparent capital markets in the world. People invest here because when they buy a stock, when they buy a bond, they know what they're getting. When I think of China, if I'm free associating, and you say to me, Michael, China, tell me the first 10 words that come to your mind. Transparency is not going to be one of those words. It's difficult to invest in China. And so because of that, and because of the lack of transparency there, and lack of property rights, et cetera, I just don't see the Chinese yuan replacing the US dollar anytime soon.
John Malden is a market commentator, strategist, armchair economist, which is the way I refer to myself most of the time, meaning I've got an idea how this stuff works, but I have absolutely no credentials behind my name. So I ask guys like Bryson who actually have PhDs and have done this their entire careers. Doesn't stop me from waxing like I know what I'm talking about, but Malden waxes, I think, even better than I. And he's warned a long time about a bang moment, that things economically and in markets go on and on and on and on, and then bang. He thinks that it's much more of an all at once, with all due respect for Ernest Hemingway, more all at once than gradually, other than we're watching it build and build and build. And then bang, we're not going to buy your debt. Bang, we need a higher interest rate. Happens all at once. Does that resonate with you in any way?
Yeah, there is some resignation there. Again, to go back to the Hemingway metaphor, it builds, and then there's a catalyst that causes the bang, to use Malden's terminology. And, if you go back again, you look at that example I talked about with the United Kingdom, there was a bang moment there. And,
yes.
Clearly I don't know what the catalyst is going to be, whether it's some sort of war, whether it's some sort of policy decision that's made here. But yeah. And what I fear, Michael, is not fear, that's a strong word. But, what I think about is democracies don't make painful choices until they're forced to do so. And that's where it could be a bang moment that finally forces us to get our fiscal house in order.
Dr. Jay Bryson is chief economist at Wells Fargo Advisors. Jay, thank you so much for being with us. And I learned so much. And this has been, I think, probably the best segment you've ever done in the 8 years that you've been kind enough to come on. I mean, this has been outstanding. Thank you very, very much. Ladies and gentlemen, that's it for another FarrCast as we cover Wall Street, Washington, and the world. I hope you learned as much as I did on this one. For me, some of the best conversations we've had in quite a while. Really. Polcari, Mahaffee, all of them. We wish that you stay warm. We wish that you stay safe. That you enjoy the peaceful transfer of power in the United States. It is one of our blessings, ladies and gentlemen. It doesn't happen in every country. I don't care which party you support or whether this is your candidate or not. This is a uniquely American moment, and it really should be appreciated. And it should almost be appreciated more, I think, if Donald Trump isn't your guy, that this still happens in the United States. We are an example to the world. We continue to be a shining city on a hill that Ronald Reagan talked about, and may that continue. So thanks for listening. Please share us on social media. For Harry Jennings and everybody at Hightower and Farr Miller in Washington, thanks for listening. God bless you all, and God bless America. I'm Michael Farr, and I'll see you next week.
And that's a wrap for this week's episode of the FarrCast. Thanks to our guests, Kenny Polcari, Dan Mahaffee, and special guest, Dr. Jay Bryson. And thanks to you, our listeners, for all of your support over the past 8 years and carrying us on into 2025. Please share us with friends and colleagues as we continue to grow our audience here in Season 8. The FarrCast is produced by Michael Farr and Harry Jennings and comes to you weekly for free on all major podcast platforms, including Spotify, TuneIn, and Apple Podcasts. Please be aware that anytime we or any of our guests mention a specific company, sector, or refer to performance in relation to an earnings report, news headline, or economic trend, it is not a recommendation to buy or sell. Review the risks and rewards of any investment with your financial advisor for what specific investment and general strategy is appropriate for you before you make any investment decision. And if we can be of help, please reach out to me at hjennings@farrmiller.com, and I'll be happy to put you in touch with one of our investment professionals here at Farr Miller in Washington to help you navigate your financial course. We are grateful for all of your notes and comments, and we try to respond to as many as we can. Please keep the emails and messages coming. Take care, stay safe, stay healthy. We'll be back with you next week on the FarrCast. Wall Street, Washington, and the world. Farr Miller in Washington is a group comprised of investment professionals registered with Hightower Advisors, LLC, an SEC-registered investment advisor. Some investment professionals may also be registered with Hightower Securities, LLC, member FINRA and SIPC. Advisory services are offered through Hightower Advisors, LLC. Securities are offered through Hightower Securities, LLC. All information referenced herein is from sources believed to be reliable. Farr Miller in Washington and Hightower Advisors, LLC have not independently verified the accuracy or completeness of the information contained in this podcast. Farr Miller in Washington and Hightower Advisors, LLC, and any of its affiliates make no representations or warranties, expressed or implied, as to the accuracy or completeness of the information or for statements or errors or omissions or results obtained from the use of this information. Farr Miller in Washington and Hightower Advisors, LLC, and any of its affiliates assume no liability for any action made or taken in reliance on or relating in any way to the information. This podcast and the materials contained herein were created for informational purposes only. The opinions expressed are solely those of the authors and do not represent those of Hightower Advisors, LLC, or any of its affiliates. Farr Miller in Washington and Hightower Advisors, LLC, or any of its affiliates do not provide tax or legal advice. This material was not intended or written to be used or presented in any way to any entity as tax or legal advice. Clients are urged to consult their tax and or legal advisors for related questions.